Hey, welcome to Stocks, Tech, and Beer, where we grab a cold one and talk about the latest in technology and the markets. And today we're going to talk about the market. One thing I've noticed lately is a lot of newcomers are calling themselves investors when they're actually traders. They're just trading stocks. And this is a very important distinction, and it's one I want to make sure you're aware of because investing and trading can both be profitable strategies if done right. But you have to do it right and you have to have the right strategy for what you're doing. And if you don't, it could cost you hundreds, thousands, even hundreds of thousands of dollars in losses over the time you're investing or trading in the markets. So to figure out what the difference is and how to make each strategy profitable, listen on. But first, we're going to talk beer like we do. Today, I'm drinking a Hefeweizen from the Lion's Tail Brewing Company in Neenah, Wisconsin. This Hefeweizen here we had at the brewery, and it was like you would expect a German Hefeweizen to be. Yeah, it even travels well. It's got that little mix of banana and cloves. It's got a real smooth finish. This is the perfect quintessential Hefeweizen. I'm gonna give this one an 8 out of 10. This is delicious. I could drink this all day long. It's so good. So, we're off to a good start here. Let's see what's going on with the difference between investing and trading. Oh yeah, and if you get any value out of this video and you like it, please hit the like button below and subscribe to my channel. You'll help me out, do a favor, and will help spread this message to more people so we can get a bigger community of like-minded folks wanting to know how technology is changing the world and changing the markets and how to profit and make a better life for all of us. First, let's start with investing. Investors that actually invest are looking for a company doing something special that'll net up profits for years to come. And then they buy into a company when it's reasonably valued and they plan to hold it for years and years and years as long as their thesis for why the company is growing is still intact. Investors dig into the fundamentals of a company. And it could be they have an amazing product coming out. It could be cash flows are going to grow like mad in the future. It could be undervalued. Or the company could be supporting a social cause that you're in. Whatever the reason, you think the company is going to grow over the coming years, you're in it for the long haul. Warren Buffett is often considered one of the world's greatest investors. And he didn't get this title by flipping in and out of stocks for a quick profit. No, he got that title for buying great businesses and hanging on to them for the long run. He bought See's Candies, he bought Coca-Cola, Geico, American Express, many more, and he held on to them for years, if not decades, and enjoyed the profits. He's not trying to trade in and out, get $500 a day or grow his portfolio by 1% a day. I don't even know if that's possible. Some people try, but Buffett knew that wasn't his style either way. He dug deep into the fundamentals of the company and he knew the financials inside and out. And he looked to see if the business had a sustainable competitive advantage. He wanted to know if the company could handle the competition. Take Coca-Cola, for example. People know soda's bad for you, yet millions of people grab a Coke every single day and drink 1, 2, 6, 12 of them because it's addictive. And these Coke drinkers, they're not drinking a Pepsi. They are only drinking Coca-Cola to get their fix. And only a certain amount of people know how to make Coca-Cola. Only a certain number of people at headquarters know how to make the syrup that they ship off to the bottlers and have them turn it into the final Coke product. And that's a business with a competitive advantage. It's sustainable. It's got a moat, as they call it in the industry. And many competitors have tried to displace Coca-Cola, but they failed. And the recipe doesn't change. The one time it did, people revolted against Coke. So the company doesn't need to make any changes. It doesn't need to put money into R&D to make a new Coca-Cola. It's got a product, it sells it. And that allows Coke to have a high profit margin, high profits, and to return equity, or return capital to shareholders. And that's great for investors. And that's what Buffett's thesis was on Coca-Cola back in the 80s when he invested in it. And he's still holding over 30 years later. That is the kind of company investors are looking for. Investors also spend a lot of time reading financial reports, the quarterly earnings updates, the annual reports companies send out, and they take a lot of time reading research reports that other people do, and they take time understanding the industry. And they'll go and read books about the industry and the world and investing to refine their investing process to make sure that they're doing what they need to do to be able to pinpoint and pick out the right companies at the right time to buy and hold for a long period. And that, in a nutshell, is what investors do. Now, let's talk about the traders. Traders will buy and hold stocks for seconds, minutes, hours, maybe a day, maybe a month, but rarely longer than a year. What they're trying to do is they usually see something, a price anomaly, and they try to take advantage of it. Or traders may speculate the price of a security will move up or down based upon a certain event coming, like an earnings report or some other catalyst coming out, like the Apple announcement of its new iPhone that's coming up soon. Traders speculate on price movement. Some famous traders include Jesse Livermore, George Soros, Jim Simons. These are names you may not have heard because they're not as famous as Buffett, but these guys are still very rich. So what does a trader do on a daily basis? Well, some of these traders will look at hundreds or thousands of charts and they'll try to see, they'll try to glean some information from the price action that the charts show. They believe that all available information about a stock is reflected in the price of the security. So when you're looking at the chart, you're seeing all the available information. So you look for patterns that happen repeatedly, and you invest if you see a pattern that you have noticed tends to go up over a period of time. And that's what they do. And this can work, but generally you need a strong system to go with it, and you want to have very specific buy and sell signals, and you got to stick to them if you're going to make this kind of investing work. Nowadays, some traders even program bots to the trading form. Systematic traders can do very well if they find a profitable system. Other traders, they'll look for short-term anomalies in the market and try to figure out how to profit from these trades. You can look at George Soros, for instance. He is known for breaking the Bank of England. Back in 1992, you saw the BOE, Bank of England, was trying to do everything in its power to maintain the value of the pound. They just got into some exchange rate mechanism, and it was a precursor to making the euro that they use over in Europe right now. But anyways, Britain was doing everything it could to maintain the value of its pound. And Soros noticed that this just wasn't going to happen. So he started shorting the pound. And he got other investors to short the pound too by explaining the situation to him, which was kind of a no-brainer now you look back at it. But anyways, the shorts piled on, and the Bank of England spent billions of pounds trying to defend the value of its currency. But eventually it just couldn't do it, so it gave up. The pound plummeted. Soros made $1 billion. And that's what a trader does. He wasn't investing in the pound or investing against the pound. He was speculating on an event happening, and it happened, and he profited immensely. So both investors and traders can make a lot of money, but you have to trade and invest in different ways. So traders look for events or clues in the current price action to see how the value of the investment will go in the future and position themselves accordingly to profit. And investors, on the other hand, think more like a business owner, and they look at what the business is doing over the long term and how it's going to affect revenues and profits going forward. And then they bring those future revenues and profits back to current dollars. And if they find that the investment is undervalued at this time, they'll go in and put some money into the stock, and they'll hang on for years as their investment thesis plays through. Both ways can make a lot of money, as I said, but you just got to make sure you don't mix them. Betting on a short-term price movement based upon fundamentals, it's not really a smart thing. Like, you don't say this is a great company, it's going to go up over the next week. That just doesn't happen. The market, as I say, the market can stay irrational longer than you can stay solvent. And that's a problem many investors face. Like, you don't invest for the short term on a fundamental thesis, but over the long term, those fundamental theses will play out. And in the same respect, you don't invest for the long term by looking at price movement and seeing what just happened in the stock without reading anything about the company. So whether you're an investor or a trader, it doesn't matter. I don't care. But you have to have a specific strategy for what you're doing. So think about what you're doing and how you want to play the markets. If you want to be an investor for the long run, buy and hold a stock, that's great, but you got to do some reading, you got to learn the company. If you want to be a trader, look at some charts or play off of short-term price anomalies, that's great, but you got to invest, you got to trade, speculate in that way. So don't mix approaches. Investors look at the business for the long term, invest. Traders look for a short-term anomaly and speculate in that regards. And with that information, I bid you adieu and cheers, friend.